Every 50% rise in crude oil has led to a recession. Every single one. So the NASDAQ officially hit bear market territory today. This is the first victim of the bear market as far as US indices goes. And unfortunately, my friends, based on the technical setup, it does not look like it's going to stop there. I will break this down for you, I promise you. Moreover, a growing number of finance experts and economists are now saying that we cannot rule out a recession. We will go over some data pointing to why a recession is very likely, or at least very plausible. However, towards the end of the video, hopefully I can give you some feelings of relief, because there are also some technical indicators suggesting that this is the time to actually put some money to work very selectively, very deliberately. And as Warren Buffett famously stated, never hold money during a war, especially when stagflation is on the horizon. And trust me, stagflation is a real possibility based on the outcome of what is going on right now with Russia and Ukraine and the effect that it is having on the supply disruption. We already had an issue with supply chain constraints. Inflation was just running amok. And now the commodities prices, especially commodities that are concentrated in that area of the world, are unfortunately, those commodities are the ones that are most important to prices all across the board, right? The price of oil really affects almost every single industry, including shipping, travel, automotive, etc. So the NASDAQ officially hit bear market territory. What does this mean for you and your portfolio? Find out here. Everything will be outlined in chapters below. Feel free to forward and rewind as you like. If this is the first time on the channel, welcome to The Traveling Trader. Happy to have you. Leave a comment down below. Let me know what you think the prospects of a recession are, and let us get right into it. So as I said, the NASDAQ officially hit bear market territory. We are down now over 20% as this candle closed. And now we have several Wall Street strategists and experts that have cut the U.S. stock outlook on the S&P 500, seeing a drop to potentially 4,000, which is a psychological level. Eddie Ardini quoting, "We now think that this could turn out to be one of the most dangerous years for stock investors of the current bull market. For the U.S. economy, we now see stagflation with persistently higher inflation and less economic growth than expected before the war. A recession can no longer be ruled out." And yes, so the difference between stagflation and inflation, with inflation, the prices are steadily rising all across the board, but we usually see that coincide with rising GDP or a strengthening economy. Stagflation is when you still have that increase in prices, however, the economy is actually shrinking or stagnating. If the S&P 500 drops to 4,000, which there is a support level there, which is basically the support from May 2021, that would represent an almost 16% drop in the S&P 500. So it wouldn't quite be bear market territory yet. However, it would be a deep correction. Now, this really, the market has been looking toppy. We have held hedges for months now, ever since going back to November. We've held hedges against the S&P 500 and the NASDAQ for months in the form of puts and short call spreads. As you can see here, this one's going all the way back to November. We also have added a lot of bots, a lot of cool features to the Discord. So we've added options bots, stock bots, crypto bots, etc. We have coaching calls where beginners can go through with a coach and learn the beginnings, the beginner level investing and fundamentals, how to evaluate a company, how to do technicals, etc. If you want access to all of this, link is in the description below. Come be a part of the community. Learn how to hedge, learn how to take destiny in your own hands, and learn some of these beginner concepts of investing. So although inflation and supply chain constraints were an issue before, now after the war, the commodities prices have just gone out of this world. I mean, you have oil hit $130 a barrel. It is up 47% in a month. Wheat is up. Let's see. Wheat is the crazy one because I've never seen wheat this expensive. But wheat for the last month, it dropped a bit today, but it is still up almost 63%, 63% in a month. Jeremy Siegel says the Fed inflation fight is way more important to the U.S. economy than Russia-Ukraine, although what the Russia-Ukraine situation evolved to now also has a direct effect on commodities prices, which directly affects the U.S. economy as well and leads to worsening inflation. But he said that it's still possible for the Fed to bring inflation under control without causing a recession, but the central bank needs to act fast. Here's the problem with that. Let's take a look at this metric here, which basically measures energy prices and the percent deviation from the current trend. Every 50% rise in crude oil has led to a recession, every single one. And we are there right now. We just hit that level. So you go back to the 1970s, you go back to the 1980s, you go back to 1990s, 2000, 2008, obviously, and then now we are at that level now. And every single time it has signaled a recession. Now, this could be correlation and not causation because the events that lead to oil being that high are usually bearish, right? Whether we're talking about war, supply chain constraints, etc. Aside from energy prices, another predictor of a recession is the 10-year, 2-year yield curve. This essentially means that when the 2-year treasury pays more than the 10-year treasury, right? Which doesn't make sense exactly. This is why it's so rare. That always leads to a recession when that curve goes negative. Let's see where we are on that yield curve. Now, we are currently at 0.36, but watch this. If this gets to below zero, while oil prices remain high, then the chances of us going into a recession are pretty damn high. Now, this situation is even more scary because we've never seen this type of commodity price inflation when the effective rates of the Fed were actually zero. We've never seen it when the Fed cannot actually loosen up monetary policy even more. Their only option right now is either to do nothing or tighten monetary policy, which could make this even worse. Goldman Sachs recently came out and said that the situation in Ukraine could lead to the largest disruption ever in commodity supplies. Key commodities, including wheat, oil, and metals, are at risk, creating what Goldman believes could be the largest supply disruption on record. Jeff Curry, who's the head of commodities research at Goldman, said the situation was bad coming into this because you had very low inventories, very little spare capacity. You put that together with the disruption that is potentially the largest disruption we've ever seen in commodities, creates a lot of upside risk. He added, the longer the war goes, the higher the probability that oil and commodity exports go to zero. Because when you think about the idea of a central bank asset freeze in the context of an energy carve-out, the two cannot coexist. I can't come up with a sustainable outcome, which suggests that the risks are very much skewed to the downside on exports of commodities, which then skews the price of the risk to the upside. All right, here's why this is not all doom and gloom. First thing, corporate earnings remain solid. As a matter of fact, if you look at the S&P 500 forward PE multiple, you can see that it currently dropped to a level very near the March 2020 Rona crash. And this is the same level that we saw after the dot-com crash of the year 2000 and 2001. The S&P 500 is not by any means cheap, but it certainly is cheaper than it was in recent history. And if you take a look at the earnings, you'll see that the S&P 500 earnings are actually growing astronomically. And this is the highest that it's ever been. So earnings continue to remain strong. Another reason why not to fret is because, and I got this from an article on thestreet.com, but if you look at this, you'll see that really the best time to invest is when the fear gauge index is very high. So if you look at the VIX, whenever it is above 35 or 40, that is traditionally when you get the best returns all across the board. And here are the returns on the different sectors: industrials, staples, financials, consumer discretionary, materials, energy, etc. So when the VIX is high, this confirms that you want to buy the fear, essentially. Another reason why not to be ultra pessimistic is because of investor sentiment. If we look at investor sentiment, and this is measured by the NAAIM Active Fund Manager Equity Exposure Index, you could see here that currently there is a lot of capitulation. Investor sentiment is extremely pessimistic at the moment. These are levels that we haven't seen since the Rona crash of 2020. Now, it's important to note that a lot of these economists that are saying that a recession is not off the table are also saying that whatever recession we see will likely be short-lived. And that is because U.S. manufacturing is on the rise again. That's because the GDP is not doing too bad, because companies are reporting record earnings. So even Eddie Ardini says he doesn't expect the turmoil to go beyond 2022. Now, as I stated at the outset, this might be a time to start nibbling. Now, what would I start nibbling on? Well, I would look for stocks that are preferably down in a bear market or close to a bear market that have already proven time and time again they have high profitability. I would stick to large caps or very close to large caps, right? And then companies that don't have any funny business on their balance sheet. And it would be a bonus if that company also has good guidance, meaning that they are expecting some sort of growth and momentum for the future, and if they also pay a dividend, although that is not necessary. So there are only a few stocks that fall under this category. We have Alphabet, Meta, D.R. Horton, Genuine Parts Auto Company, Walmart, Kroger, etc. So there are a lot of value stocks on here mixed with some mega cap growth as well. So there you have it, folks. NASDAQ officially in bear market territory. Could get a little bit worse for all the indices across the board, especially as commodities prices continue to rise. The longer that this war wages on, the longer that commodities prices, the longer time that commodities prices will rise and make stagflation a plausible scenario, a very plausible scenario where the economy is not growing as much as it was last year and the year before, but now inflation is just getting out of control. Pay attention to the CPI numbers that come out March 10th. Pay attention to what the Fed does on March 16th. Do we get that quarter point, really benign, minimalist rate hike, or does Jay Powell actually overshoot and try to go for that 50 basis point rate hike, 75 basis point rate hike? It will be very important to how stocks behave in the short term. Pay attention to the 10-year, 2-year yield inversion. Make sure that that does not go below zero. Also, pay attention to the price of oil and see if we can get a quick slowdown in the price of oil, or will it continue to wreak havoc? Because right now, the price of oil, especially when it's represented as a percentage deviation from the trend, is at 50%. And remember, every single time in history it hit 50% or more, we went into a recession. If you want access to all of our trades, you want to learn how to hedge stocks, options, crypto, futures, etc., link is in the description below. We talk trades all day, every day. Would love to have you. Subscribe to the channel, hit that notification bell, leave a comment down below. Let me know what you think about a recession, stagflation, etc. Stay safe out there, traders. Peace.